Right now, there are over 100 million Americans who are either uninsured or dangerously underinsured when it comes to life insurance. That means if something happened to them today, their family would be financially devastated within months. And the terrifying part? Most of them have no idea. Chapter 1. The basics that nobody actually explains. Life insurance is a contract between you and an insurance company. You pay them a monthly or annual premium, and in exchange, if you die during the coverage period, they pay a lump sum, called the death benefit, to whoever you've named as your beneficiary. It sounds simple, but the devil is in the details. There are two main types of life insurance, and most people choose the wrong one. Or worse, they mix them up without understanding the difference. The first type is term life insurance. This covers you for a specific period, 10, 20, or 30 years. And if you die during that window, your family gets paid. The second type is permanent life insurance, which includes whole life and universal life. These last your entire lifetime, and often include a cash value component that builds over time. Now here's where most people go wrong. They see a whole life policy and think they're being smart, getting coverage and savings in one product. But in reality, the returns on that cash value component are historically poor, often between 1% and 3% annually, while the same premium dollars invested in a simple index fund could have grown at 7 to 10% per year. Chapter 2. The real cost of getting it wrong. According to LIMRA, the Life Insurance Research and Marketing Association, the average American family that does have life insurance only has enough to cover roughly 3.5 years of income replacement. Financial experts, however, recommend a minimum of 10 to 15 times your annual income. Let me put that in real numbers. If you earn $60,000 a year, you'd need somewhere between $600,000 and $900,000 in coverage. But the average policy? Closer to $200,000. That gap, that $400,000 to $700,000 shortfall, is the difference between your spouse being able to keep the house, maintain the kids' school, and rebuild a life, versus having to move in with relatives within 18 months. And here's what makes this tragedy even worse. Life insurance is far cheaper than most people think. A healthy 30-year-old non-smoker can get a 20-year, $500,000 term life policy for around $25 to $30 per month. That's less than most people spend on streaming subscriptions, but they never buy it, because nobody sat down and explained the math. Chapter 3. How insurance companies actually make money. To understand insurance, really understand it, you have to understand the business model. Insurance companies make money in two ways. First, through underwriting profit. They collect more in premiums than they pay out in claims. Second, through investment returns. They take the premiums you pay and invest them in bonds, real estate, and equities while you're still alive. This is called the float. It's the same model Warren Buffett has used to build Berkshire Hathaway into a trillion-dollar empire. Now, this doesn't mean insurance companies are evil. It means they're businesses, and understanding that changes how you should shop. Here's the key insight. Insurance companies use something called actuarial tables, mathematical models, that predict when statistical groups of people are likely to die. A 25-year-old healthy non-smoker, they're extremely unlikely to die in the next 20 years, which means the insurance company can afford to charge that person very little, because the odds overwhelmingly favor them. That's why buying term life insurance young and healthy is one of the smartest financial moves most people never make. Chapter 4. The underwriting process. What they're really judging you on. When you apply for life insurance, you go through a process called underwriting. The insurance company is essentially asking one question: how risky are you to insure? They look at your age, your health history, your driving record, your family medical history, whether you smoke or use tobacco, your weight and BMI, whether you have certain risky hobbies, things like skydiving or motorcycle racing, and in some cases, even your credit history. Based on all of this, they assign you a rating class. The best rating, usually called Preferred Plus or Super Preferred, gets you the lowest premiums. If you have some health issues, you might be rated Standard, meaning you pay more. And if you have serious health conditions, you might be rated Substandard, what's called Table Rated, where you could pay significantly more. Here's what this means for you practically. Getting a medical checkup, quitting smoking for at least 1 year, losing weight, and paying your bills on time can literally save you thousands of dollars over the life of a policy. Underwriting rewards health, which means the best time to buy life insurance is always before your health deteriorates. Chapter 5. The 5 biggest mistakes people make with life insurance. Mistake number 1. Waiting too long. Every year you delay buying life insurance, your premiums go up, and your health could change in ways that make you uninsurable. Mistake number 2. Relying solely on employer life insurance. Most employer policies offer 1 to 2 times your salary, far below what you need. And when you leave that job, the coverage disappears. Mistake number 3. Naming the wrong beneficiary or forgetting to update it after a divorce, a birth, or a death in the family. Your insurance company will pay whoever is named on that form. Judges have seen this go horribly wrong. Mistake number 4. Buying the wrong type. If you have young children and a mortgage, term life is almost always the right call, not whole life. The math on whole life simply doesn't add up for most families. Mistake number 5. Setting it and forgetting it. Life insurance needs change. When you had kids, when you paid off the mortgage, when your income doubled, those are all moments to reevaluate your coverage. Insurance should be reviewed every 3 to 5 years or after any major life event. So here's the bottom line. Life insurance isn't about death. It's about what happens to the people you love after you're gone. It's about making sure the mortgage gets paid, the college fund survives, the surviving spouse doesn't have to upend their entire life in the middle of grief. The good news is, getting this right is not complicated. Get a term life policy, get enough of it. At least 10 times your income. Get it while you're young and healthy, and review it every few years. That's it. If this video helped you understand something that your financial advisor never took the time to explain, consider subscribing. We break down financial topics like this every week, in plain English, with no agenda. Hit the subscribe button, and we'll see you in the next one.